if the consumer's weak and housing is weak, to me that's enough to kind of say, like, you know what, it's going to be very difficult for the economy to not have a recession.
Hi, everyone. I'm Gunjan Banerji.
And I'm Telis Demos. Welcome to another episode of WSJ's Take on the Week. So, Gunjan, it seems like we're back on Fed watch in the markets these days. Do you agree? The inflation reports have driven Fed expectations, and that's moved the market. Is that your sense of it?
Seems like the big bet in the market right now is that the Fed is going to cut rates at its September meeting, and that's helped the stock market.
Yeah, and we've got more economic data this upcoming week on the housing market that I really think that we should dig into, and that'll be the big conversation for this week. But I do want to just talk a little bit about backwards looking at the inflation reports that have come recently. We had a consumer price index report that, while itself wasn't especially hot, had some interesting elements in it. It had a slowdown in something very important, which is shelter costs, right? Like what people pay in rent and to live. And that's really important. And it didn't show a huge pickup in goods inflation, right, which is sort of the tariffs thing. Services inflation was still running hot, but it seemed like the reaction to it overall was that it could support a Fed cut in September.
That's right. So the S&P 500 hit its 16th record of the year after that
back
CPI report. Right. We're back at all-time highs. And I think the impact of tariffs on markets, on goods inflation, has just not been as straightforward as a lot of people thought just a few months ago.
But we did have a bit of a reversal when the producer price index, which measures wholesale prices, came out, and that was hotter than expected. And so that's an indication that maybe companies are paying a little bit more to make the stuff that they sell to you. And the market went down on that news. We had Mary Daly talking to the Wall Street Journal. She said that a 50-point or half-point cut in interest rates would maybe send the wrong signal about how weak the jobs market is. We had, of course, that not so great labor market report, but it wasn't terrible in her view. And so 50 basis points or half a point would be too much. We also had Austin Goolsbee, who's been on our show before and who, based on that, we know isn't totally averse to cutting rates.
Sure. But
he said that he's still not convinced that a cut is the next move. So it seems like that's the direction of travel maybe, is that we're not so sure about a cut now.
The market does seem pretty sure, right? I think investors do seem to be banking on an imminent rate cut. Of course, they've been wrong about this before. But I think either way you look at it, the big story to me, or kind of the big takeaway for me the past few weeks, is that every single decline that we have in the stock market, you see individual investors, institutional investors jump in to buy that dip. We saw that after that hairy labor market report just not too long ago. And I think that's really helped propel markets. And it marks a pretty big shift in how markets function these days, where you have this cohort of investors that's ready to step in, ready to provide support to the markets on any sign of weakness. And I think these individual investors kind of function the way short sellers did in the past, where they would step in to buy during times of market panic.
And what do rate cuts do for those investors? Because it seems like one reason that the market might rally when the Federal Reserve is talking about cutting rates. Because, look, the reality is that the reason that the Fed might cut rates is because the labor market is weakening, right? The economy's not doing that great. So you would think that maybe the market would say, oh, boy, if people are going to lose their jobs, they're not going to buy stuff, they're not going to pay back their debts, bad for the economy. But maybe the reason that people are looking at a rally is because they think that lower rates will continue to fuel this kind of retail pouring of money into the market. Is that the case?
Well, look, higher interest rates did not pour cold water on that trade. So it's really unclear how that's going to shake out. And I think another thing driving this is that people have been rewarded for stepping in. You're seeing Americans' finances more intertwined with the stock market than they ever have been before. The Journal recently had an article about how 401ks have been drifting more and more towards stocks. Someone I spoke to the other day mentioned or pointed out that the share of American net worths that are concentrated in stocks is hovering around 36%. That's the highest level in records going back to the 1950s.
Well, the Journal had a story that even in target date funds, which are the sort of supposed to be the very classic sort of conservative investments for retirement funds, even those are pretty overweight stocks these days. And while I take your point about high interest rates didn't seem to discourage retail investors a couple of years ago, I do think that dropping rates from here could fuel things a little further. You have the fact that, people who might be in cash will be getting less of a return on that cash, especially when short-term rates are cut. And so they might move into risky
Though
assets. You also
I
have
will point out that people often think that the second rates move lower, that money pours out of money market funds. That is not how it's worked. I think money in money market funds is way stickier than a lot of people think.
Interesting. Well, I mean, I know that's true for institutions. I wonder, though, if maybe some just, individuals might be sort of convinced to start investing more of their money. Well, like I said before, we do have some upcoming data that I think will be very relevant. And one of them is the existing home sales report. And what's interesting about this report is that it highlights a couple of things. One is the number of sales happening. The other is what is in inventory, that is people who are trying to sell, essentially. And then also the prices at which homes are moving. And the trend we've been seeing thus far in the data is that sales are pretty flat, but inventory is growing. This isn't true in every region necessarily, but nationally, prices are still kind of moving a little higher. And that's an interesting scenario because I think that part of the case for lower rates is that the housing market is stuck, right? We don't have enough people buying houses, and one thing that's discouraging them are high mortgage rates. And so if we cut mortgage rates, maybe more of those people who want to buy will buy. But my question, Gunjan, is what does that do to home prices? Do home prices have to come down too?
Neil Dutta and I dove into this in our conversation for this week, and he had some really interesting thoughts on where the housing market is at right now. He thinks it's in a recession. And you and I are talking about where's the economy headed from here. He mentioned the housing market is such a big part of the economy that if it's in trouble, that could spell bad news for the rest of the economy.
Well, so this is the big question I have. What's essentially worse for the economy? Is it nobody buying and selling, and therefore nobody going out to buy stuff at retailers like Home Depot and Lowe's, who, by the way, are reporting earnings soon? Or is it worse if home prices are falling? People are buying and selling, but everyone's house price is coming down because that's the new market clearing price. And I think that the conversation that you had with Neil Dutta, who is the head of economic research at Renaissance Macro Research, will really help us answer that question. So we're going to have that conversation after the break.
Well, Neil, thank you so much for joining me today. I know we have tons to dive into with what's going on in the housing market right now here in the U.S.
Well, I mean, right now the housing market's probably in a recession. Builders aren't making homes. The labor markets are very much in focus. And, I think probably you start to see some weakness in construction employment going forward because, right now builders, I think, are trying to align their construction activity with their sales. And sales have generally been slowing. So it's only natural that construction follows.
Yeah, so give me your 30,000-foot view here. You've said that the housing market is in a recession. What indicators are you watching, or what are you watching that gets you there?
You look at a variety of indicators, but obviously if you look at single-family building permits, they're down over 30%. That's sort of the backbone of the housing market, single-family residential real estate. So the fact that that's down implies that we probably won't see much construction activity over the course of the year. If you look at new homes sold but not started, right? So a new home sale is booked when the contract is signed, right? So it's considered by most economists to be a leading indicator of the housing market. The fact that new homes sold but not yet started, that's down substantially as well. So there's not really much in the pipeline for new construction, and that's really different from where we were in 2022, right? So if you go back to that period, right, remember the Fed basically broke the housing market really without even hiking, right? They started talking about hiking, and then longer-term interest rates rose, and the housing market cooled off. What kept builders going at the time was there was this massive backlog of housing that they still needed to get through, and so that kind of kept them busy. But they don't really have that today.
Falling employment in the construction sector can be a really bad sign for the economy.
I mean, it's growing at a pace now that's typically consistent with very, very weak economic activity, right? So, and as I say, you don't really have much growth in the pipeline. Think about what builders have been doing over the last year to kind of move a lot of their homes, right? They've been offering rate buy downs. They've been providing all sorts of incentives to get people to buy homes because they have strong balance sheets. But that can only go on for so long. And now, do you want to keep selling homes at a reduced margin, or do you want to kind of right-size your business? And I think a lot of these builders want to right-size their business. And what that basically means at this point is probably they're going to be making fewer homes. They're going to be focusing on the homes they've already sold finishing those, and they're probably going to rationalize their labor demands.
So what does that tell us about consumers right now?
Well, I mean, housing is a big part of why people spend money. I mean, homeowners tend to spend more money than renters because there's a lot of things that you need to buy if you own a house, right? I mean, for example, you sign a contract on a single-family new home. That usually means single-family detached. It probably comes with a garage. You fill the house with stuff, right? Appliances and furniture.
There's always something to renovate.
Furniture, a car, tools, all sorts of things. So there's a multiplier, I think, from housing, home sales in particular, to consumer spending. So to the extent that housing is weak and housing construction is weak, it probably means consumers more generally are going to be spending less on durable goods, for the home.
So help me make sense of this a little bit, because I was looking at some Yardini research data, which showed that household net worths at a record high in the first quarter.
Okay.
I know sales have been slowing, but home prices still close to records, right? So how can we say that the housing market is even doing that badly, or that consumers are not doing that well when net worths are up there, and their home values are still up, right?
Is there ever a time in economic cycles where net worth isn't close to an all-time high right before the slump? That's always the case, right? I mean, in 2007, people were saying the same thing. The market peaked in October of that year. Just because you have, I guess, these indicators that suggest stability or things are fine, that doesn't necessarily mean that they are, right? So, to me, it's not so much that household net worth is at an all-time high. It's that the direction of travel is clearly worse because home prices are contracting. They have been now for 4 or 5 months.
Sure.
And that's the primary asset on most households' balance sheet, not stocks.
So June sales were flat, but inventory was up, right?
Mm-hmm.
And prices were also up. Do people need a reality check in terms of how much their homes are worth? Are they expecting?
Well, that's what's happening, right? And so one of the things you're seeing at the moment is that a lot of sellers are just removing their homes for sale because they're not getting the price they want. But that has ramifications for, people, because now someone that owns a house is going to know, well, maybe my house isn't worth as much as they thought. And if you believe that, then that means if your net worth isn't as strong as you might have thought, and therefore maybe you're saving a little bit more money as a result. And it also would mean if a lot of the people that are listing their homes had been listing are no longer listing, that means that the inventory that's out there, by the way, which is still growing, that means no one really wants that inventory, which means that those prices will have to come down even more to move. So that's, again, another reason why you should expect ongoing declines in prices over the remainder of the year.
That sounds like a rude awakening for a lot of people.
Look, to me, the housing market is not in a good place. I mean, it's Redfin has this statistic where they talk about how, sellers are outnumbering buyers by a very, very wide margin. But, it's obviously, if that's the situation, it's very easy to call for an ongoing decline in home prices. But I think what's really important is that the prices are falling in the markets where the builders make the homes. For example, I live in New Jersey, okay? And my next door neighbor put his home up for sale maybe a week and a half ago, and it's already under contract. There's not a lot of inventory in the Northeast. But then again, builders don't really build a lot of homes up here either, because that's not where the population is growing the most quickly. Now, if you go down to Florida, Texas, Arizona, inland California, Georgia, these are the markets where the builders make a lot of the homes. And that's also the places where you're seeing very, very rapid declines in home prices. So to me, that's why it's more onerous, is because the prices are falling maybe nationally it doesn't look that bad on the surface, but if you look under the surface, look at the states where the price declines are steepest. That's also where the builders make the houses. And that is why the GDP impact might be a little bit more precarious this time. And for economists, what we talk about is residential investment, right? And residential investment has 3 pieces, right? There's the construction piece. There's sales. So when a home is sold, the commission that the broker gets booked into GDP, okay? And then renovations, home renovation spending. Those are the 3 parts of residential investment. And construction is probably, I would say about half of it, okay? So right now, you don't really have much in construction, and you have weaker growth in renovation spending because labor markets are slowing and credit use is slowing. So, I mean, if you think about housing in those three terms, in those three parts, I mean, it's very difficult to sort of lay out a very optimistic kind of thesis right now.
So you think some of the declines that we've seen in these pockets of the U.S. could spread through other parts of the country?
I mean, it could, but it doesn't even have to, because that's where all the growth is happening anyway.
Okay.
To me, my biggest concern is what happens now with employment.
Yeah.
Because I think that builders are going to start laying people off. And when that happens, that, to me, you talk about like a rude awakening, that's the rude awakening. I don't think the Fed really focuses enough on housing when they talk about like rate cuts. And I think the reason why you want to focus on housing is because obviously it's a very credit-sensitive area. And also importantly, it's because it has like a lot of spillover effects into other parts of the economy. But to me, you know, the fact that there's a potential down cycle in construction employment, I think, is very important for for the Fed to kind of consider.
We've been hearing about this affordability crisis in housing.
Okay.
Does what you're saying mean that it could be getting better, but for the wrong reasons, maybe?
If you have falling rates, that's going to help affordability. If the rates are declining because people are losing their jobs.
Okay, when we had falling rates the past few years, that didn't help housing affordability, though.
It didn't, because prices were rising more rapidly. Yeah.
Why do we think that could happen this time?
I guess the question is it a good thing when rates are coming down and home prices are coming down because people are sniffing out economic weakness? Like, that would help affordability ratios. I don't know that it would be the best thing for the economy.
And I guess inflation would get better.
Inflation would get better because there would be more slack in the labor market and people wouldn't be making as much money. And so prices would have to adjust lower.
So you've said you think the housing market is in a recession right now. Can the housing market be in a recession without the entire economy falling into a recession?
That can happen. It's not usual. I mean, it's not normal.
Has it ever happened before?
Yeah, we were in a housing recession in 2022, but we also had loads of mana coming down from the government, and we don't really have that as much these days. So I think it's a more challenging situation, right? I mean, the labor markets aren't as strong as they were two or 3 years ago. The government's not helping as much as they were 2 or 3 years ago. You didn't have like a synchronized reopening out of COVID like you did a few years ago globally, right? I mean, we have trade wars and things like that. So I think there's more headwinds now. So it would be very difficult if the housing market remains weak. I mean, that's going to kind of underpin ongoing domestic weakness. And, you know, for me, I've kind of described the economy to our clients. I mean, basically, as we have like sort of three economies right now, right? You have the housing market, which is in a recession. You have the consumer, which is, you know, kind of sluggish. And then you have like this AI thing in the background that's just like there's just an insatiable appetite for. And, you know, as a U.S. economist, it's very difficult to say like, oh, yeah, AI is going to just overwhelm everything. Like, I don't really believe that. So I think if the consumer is weak and housing is weak, you know, to me, that's enough to kind of say like, you know what, it's going to be very difficult for the economy to not have a recession. You know, so I think for me, the markets are underpricing the risk of one.
AI isn't going to save the housing market.
No, I don't think so. I mean, in some cases, it may make things even worse for people, right? Because, you know, the immediate consequence of it is basically to put massive demands on the electrical grid, right? I mean, so there's a huge demand for energy because of the AI stuff, and that's going to show up in household utility bills over the next number of months, years, quarters. And the productivity benefits of AI, I mean, people talk a lot about it, but when you look at the data, it's not really there yet. So there's a bit of a productivity paradox with this. So, and it's ultimately going to be useful insofar as you start to see stronger investment and real wages, right? And that hasn't happened. So right now there's arguably some costs or externalities maybe associated with the AI build-out. That could be weighing on consumers and households. You know, look, I mean, for the economy, I guess for me, it's really you have to focus on like the bread and butter, and that to me is basically U.S. housing and the consumer.
We are going to take one quick break,
Okay.
and then I have a final question for you. If you had 30 seconds with Fed Chair Powell to advise him on policy specifically as it relates to housing, what would you say?
I would say you should have gone in July and you should be cutting in September. And I would say you should, I would say you should overweight the growth part of your mandate relative to inflation, because inflation is a lagging indicator, and ultimately, longer run inflation expectations are anchored. So you should be worried more about the growth outlook. To me, the housing market's been weak for some time. And if you're looking at housing, look at what's going on with home prices. They're contracting. So that to me is an important signal. So I think I would tend to nudge him towards the more dovish side of the fence at the moment.
You would say, I agree with President Trump and you should be cutting rates.
I wouldn't say it like that, but I would say you should be cutting rates. Also, look, they don't really have a very good rationale to say, he's been asked multiple times about, how do you think tariffs are going to be anything other than a one-off price increase? He hasn't actually been able to answer that question very well. So I think that's pretty revealing. The New York Fed put out an interesting survey where they looked at consumer expectations 1 year, 3 year. It's basically at the same place it was to start the year. So that to me suggests that inflation expectations are anchored. There's really no threat that it's going to get unanchored at the moment.
They have been the whole time, right? They never got out of control.
Some surveys showed that it got out of control, but even those are improving lately. So, yeah, I think that to me, the rationale to let's hold off because inflation expectations are potentially going to come unanchored. There's no evidence that that's happened. And so, it's their job to make decisions with imperfect information. You can't just be tariffs, something can happen, let's not do anything until you know all the details. By the time you've waited for all the details, it might get really bad, right? To
be fair, it feels like there's a lot more details. It seems more uncertain than usual in terms of policy.
It's their job to make decisions in an environment of uncertainty. The argument that I can't really stand these days is, we're much closer to our unemployment mandate than we are to our inflation mandate. Therefore, we should be looking at, we should be putting more weight on inflation. Therefore, we should wait. The risk with that, of course, is that, yes, it's true that the unemployment rate is at 4.2% and your longer run estimate is around 4%. So you're closer on unemployment. Fine. But the labor markets can move a lot more rapidly than inflation does, right? That's also true. So you may be at your target today. That doesn't necessarily guarantee you that's going to be the case in a few months, right?
And you are worried that we're kind of at that tipping point in terms of the labor market where things could start to go south.
The economy's on thin ice. The first half of this year, you saw AI adjacent stuff like information processing equipment, software, that added more to GDP growth than the consumer. It's unprecedented. That's very rare to see that. So you have a very small slice of the economy adding more to GDP than the consumer, which is the biggest piece of the economy. So I think that's a bit concerning. Yeah. You can't run an economy just on AI.
Thank you so much, Neil. This has been great.
Thanks, Gunjan. Appreciate it.
I know you're warmed up from CNBC. Right?
Yeah.
Although I guess that was a little shorter. How long was that?
It was 10 minutes.